We're now going to turn our focus to what some people call America's blind spot, the private sector debt. To begin this segment, Richard Vague, chairman of the Governor's Woods Foundation, one of the underwriters of this event, will give a short presentation, and then he's going to sit down with Fox's brand new chief political correspondent, Jonathan Allen. Richard Vague, the floor is yours.
Thank you very much. Thank you. It's great to be here. I hope we have our slides up. Today, I want to invite you to start thinking about countries and economies in a different way. I want to suggest that you start giving private debt, as measured by the private debt to GDP ratio, an equal or greater consideration than public debt. It's generally a larger number in most countries. Private debt causes growth to increase. It has the greatest impact of any factor on GDP growth, but private debt causes major problems when it grows too fast or gets to levels that are too high. An easy way to look at this is with what I call the country debt matrix, and that's what we have here. Now, this is 1980, and here are the world's 10 major countries in 1980. They collectively comprise more than 65% of world GDP. Each country is a matrix point here. Now, the x-axis is the private debt to GDP ratio. The y-axis is the public or central government debt to GDP ratio. We also show in darker gray over here what I call the threshold of concern for private debt. If private debt were, if any of the data points were in this area, private debt at that level actually dampens economic growth. Now, I put private debt and government debt on two different axes because they are qualitatively different. A government that issues its own currency and issues debt in its own currency can pay its debt by issuing more money. Businesses and individuals don't have that luxury, so it's a qualitatively different thing. We use this graph to create a matrix. So we have labeled here a low level of private debt, a medium level of private debt, a high level, same for public debt. So you notice here the U.S. in 1980 had a medium level of private debt, here we are, and a low level of government debt. So we would call that a medium-low or ML country. And a country with, we have right here, I put HH. That would be a country that had high public debt and high private debt. In 1980, the world's in okay shape relative to this issue. Nobody is in the HH box, and nobody is out here in the private debt threshold of concern area. Now, most folks are clustered at medium-low. I have that circled for you. Now, after 1980, there's a steady increase in the private debt to GDP ratio, with frankly runaway private debt increases in the early 2000s that led to our now famous 2008 crisis. Rapid growth in private debt creates overcapacity, too many houses, too many office buildings, and creates bad debt in the process. In 2007, in the United States, we had $2.5 trillion worth of private loans and only about $1.5 trillion worth of bank capital. Runaway private lending is what leads to all major financial crises. Now, I want to talk about this a little bit. This number right here is the increase in the private debt to GDP ratio in the United States in the 5 years before the crisis. Reasonable, healthy private debt to GDP growth is probably in the 0 to 5% range if you look at it over the last 100 or 200 years. You can see all these countries, and frankly a long list of countries beyond these, had very rapid private debt growth far in excess of that 0 to 5 threshold. We're at 17. You can see Spain at 53% in 5 years. Greece, it'll be no surprise to you, is the worst offender in the group, and in fact, this is what caused their crisis. And frankly, as the McKinsey folks were saying earlier today, the world has not delivered much since then. Now we move to 2014, really the most recent data point we have, and the world has changed dramatically. Here for reference, you see that kind of same HH point we looked at in the earlier graph, but the countries have moved from here in this 20-plus year period to here. Most countries are at a very high level of private debt and a medium to high level of government debt. And most countries have moved into this darker gray area, which we call the private debt threshold of concern level. That means that growth in their economies is impacted. Now, the Eurozone's problem today is private debt. That's what's strangulating growth. It was causal. High levels of private debt make demand low, and therefore make inflation low and interest rates low. China, you'll note, went from not appearing on the earlier graph at all to being one of the leaders in the private debt pack, and we think, frankly, it's on the verge of its own crisis. Now look at Japan. Japan is almost sui generis. Runaway debt caused Japan's crisis. Remember in the 1980s when Japan was about to take over the world, or we all thought it was? That was runaway private debt. And notice that Japan's still at a very high level of private debt. In fact, 24 years later, Japan's businesses are still 50% more leveraged than U.S. businesses as a percent of GDP. 24 years later, over-leverage in the business sector is still Japan's biggest problem, though almost no one mentions that. And I want to mention something else briefly. There is no global savings glut, even though that's something that is alluded to repeatedly, including earlier today. We've got a global debt glut, if you want to look at the data. Now let's take a 200-year look at the United States from 1800 to today. You can see back in 1850, we had almost no public debt and very low levels of private debt. And since then, we have been on a 200-plus year march from low to high in both private and public debt. Now, some pass this off as mere financial deepening or financialization, as if it were a good or inevitable thing. But it is true for an individual or a business. Low or moderate levels of private debt are fine, but when it is too high, it increasingly strangulates growth. This progression from low to high for private and public debt is what all major countries do. They go from under-leveraged on the private side to leveraged, which frankly early on provides a huge boost to economic growth, but when they get over-leveraged in the private sector, it suppresses growth. They approach a limit, if you will, which we believe is in the 200 to 250 range. This is grossly under-recognized and at the heart of economic reality. Most or all the talk that you will hear in economics is about monetary policy and fiscal policy. But at best, these two musty, moldy old tools which dominate the discussion are inadequate. More likely, since private debt is the true key, they are also ineffective. Private debt restructuring, addressing the private debt issue, is the missing ingredient in discussion about the world's economic struggles. And let me see. So with that, I'll invite the moderator to the stage.
Thank you. I learned two important things from that. Number one, private debt is more important than public debt in terms of assessing ourselves. And number two, I apparently can't issue my own currency to pay off my debt. So if you'll excuse me a minute, I'm going to call my wife. I've been spending too much. One of the questions that arises from the presentation there, one of the big questions obviously is looking at China. As you said, it wasn't on the earlier slides, and then you look at it, and you say China's headed for a crisis. How fast? What are the contours of that? How do you think that affects us?
Well, it's the biggest economic event at the moment. We talked about, say 15 or 20% growth in a 5-year period being kind of the tripping point for a crisis. We've seen it again and again and again. China has grown 60% private debt to GDP in the last 5 years. And in fact, since our 2008 crisis, China's private debt has increased by the equivalent of $12 trillion. You talk about overcapacity, we talk about ghost cities, they've got it in spades. I think the thing that is already starting to happen, and it's largely driven by China's now slowdown, is two things. First of all, we're seeing commodity prices tumble. China built way too much of everything. And the beginnings of their slowdown is the causal factor behind the 50% drop in iron prices, steel prices, similar declines in copper, aluminum. We're seeing China housing values go down for the first time. The other thing that we're going to see, the other manifestation, is China, which has been the world's growth engine, is starting to slow down. Their nominal growth rate in this most recent quarter was only 5.8%. I think it's going to decline to no higher than 3 to 4%. It may emulate Japan in that it has a generation of near zero growth. That's frankly what we would expect. We think the spillover is going to be profound. It's going to be felt widely in Asia Pacific. Australia is certainly feeling it already in a profound way. Africa and South America, which have made a living exporting to China over the last 10 or so years, are seeing dramatic slowdowns. You're seeing it in Brazil, Peru, Tanzania, country after country. We're going to feel it in the United States, but it's going to be mixed. There's actually going to be winners. China's slowdown contributes to the decline in oil prices. There's winners on that front in the United States. There's also a lot of energy companies that are losers because of that. So I expect the U.S. to be least affected, but I expect there to be a mixed bag of winners and losers.
More on the domestic front, you made the point that there's all this focus on public debt, and we hear about it all the time. We hear about it on Capitol Hill in endless floor speeches. We hear about it on the presidential campaign trail. It seems like that's the comfortable place to have a debate, because if you're going to tell people that you need to reduce your private debt, it would mean fewer things for the average consumer. We're all super leveraged in our houses and our cars and various other things, and just basic credit card debt. What's the political solution to getting people to behave differently, or to getting, and I don't think you talked about this here, but I've heard you talk about it before, enticing businesses to restructure debt for people?
Well, I think there's a practical example out there that's also one of the most important examples in the U.S. economy. There's 52 million mortgages in the United States. Here, 7 years after the crisis, 9 million of those 52 million mortgages are still underwater. I think, and frankly, the people that are carrying mortgages, these are folks with a $300,000 house but a $500,000 mortgage or a $400,000 mortgage. These people are impeded from participating vibrantly in the economy. They can't afford vacations. They can't afford new cars. That may be the biggest single drag on the U.S. economy that there is. I think there's innovative, creative ways to deal with that. I think one thing you could do, in the spirit of what Paul Volcker did in the Latin American debt crisis, is you could let the banks restructure with borrowers, but let the banks take that pain, instead of up front, take it over 10 years or 30 years. They restructure with the borrower, and the borrower perhaps gives a equity participation in the future sale of the home in trade for having been granted a restructured loan. If you did that, there would be a profound change in the economic profile here in the United States.
What is the difficulty there? Because it seems to me like our government is actually encouraging us to leverage more, not deleverage. I mean, when you talk about housing, for instance, the first thing we did after the crisis, when all the homes were underwater, is we started making it easier for people to borrow money again to buy houses. What is it that the government can do, should the government do, and is there a way to get members of Congress, presidents, to start thinking about this differently?
You know, I don't know the political issues, but I'll tell you, you know, for all the talk about the loosening of mortgage requirements, mortgage loans have been flat for several years now. They're kind of low 9 trillion type of a number, and that number more or less hasn't budged for a long time. And I think I don't think the right way to attack that problem is through tax policy, through programs, this and the other. I think it's this 9 million, there's this huge lump of 9 million underwater mortgages that we need to address before the mortgage market starts behaving in the way we'd want to again.
Is there an appropriate level of private debt to GDP ratio that is helpful for a growing, healthy economy? Where is that? We could see the low, medium, high in the slides, but what's the ideal?
Well, you know, we've seen studies from the BIS and from the IMF. We've done our own studies. A lot of folks have that. You know, it starts to be a concern once you get over 100, 125, certainly by the time you get to 150% of GDP. The U.S. right now is at 146% of GDP. Japan's at 170%. Spain's at 200%. Portugal's at 255%. Ireland's at 300%. So you can see where the problem spots really are. I think 150 starts to become an area where you need to do serious examination of the issue. Certainly the 200 to 250 range is clear red flashing light.
And back to the sort of the consumer level and the human behavior level, it seems to me that if you do deleverage or you make it easier for people to, say through mortgages, restructuring student debt, easier for people to pay those things off over time, they're likely to just use the money that's freed up as more leverage for themselves to borrow other things. And maybe not everybody, but what's your confidence level that if suddenly private debt were to go down, that it wouldn't just bounce back up?
Well, of course, there's the tendency over 200 years for the world to always become more leveraged on the private side. I spent most of my career in banking, and I can tell you the single biggest driver of whether loans grow fast or slow is the capital requirement imposed on the lenders. You hear about this a lot, Basel II, Basel III, and the like. Banks generally have about a 10% capital to loan ratio. This really almost never comes up in economic discussion, but if you want, I don't think it's the moral bent of the lenders. I don't think it's the moral bent of the borrowers. I think it's how much capital you have, to lend more. So I think if you changed or increased the capital requirement to banks in a meaningful way over time, that alone will dampen this growth going forward, irrespective of the moral predisposition of the participants.
Who's got it right? We saw a lot of countries that are moving in the wrong direction. Which countries have it right now?
You know, I'm not sure I can come up with someone who's got it right. You know, there's only one exception to this behavior, and that's Germany. But Germany's an outlier in a totally different way. You know, the United States, our exports to GDP are about 13%. In China, they're only about 25%, and we think of them as a big exporter. Most European countries have exports of around 20 or 25% GDP. In Germany, it's 53% to GDP. So Germany's private borrowing hasn't occurred within Germany. It's occurred in all the other European countries to buy German goods. So that's an outlier, but we think it's a problematic outlier.
And on the public debt side, do you think that we've got a lot more capacity in terms of debt to GDP ratio on the public side? I mean, could the government be spending even more than it is taxing and be in a comfort zone?
I think...
and would that help the private debt at all?
Let me give you an illustration of this. We're at 100% public debt to GDP. Japan's at what, 240% public debt to GDP? So clearly we can go higher. I don't think we should. I don't think we need to. If you think about it, public debt is what a country... public debt actually gets better in the years before a crisis. In Spain, right before their crisis, in the 5 years, public debt to GDP improved 13%. Government tax revenues were flowing in. They thought it was an economic miracle. Where public debt starts to increase is after the crisis, as folks look for ways to stimulate the economy and as tax revenues fall. Japan, their public debt to GDP in 1991, when they had their crisis, was 60%. Their private debt was 220%. In the 24 years since, their private debt has gone from this 220 number down to 170. That's had a suppressing effect on their growth. Public debt, as they've tried to solve their problem, has gone from 60% of GDP to 240% of GDP. They clearly haven't been able to solve the problem with public debt. It's helped. It's been a palliative. I think the missing ingredient is restructuring private debt. If I were given a choice between using government debt to stimulate economy and giving relief and restructuring to borrowers, I'd always choose the latter.
Every situation?
Every situation.
So when you're looking at the timeline here, and you look at the private debt going up before a major crisis, and you've obviously, I think, made the conclusion that they're leading to those crises, that the private debt is responsible for that. What are the other factors you're looking at, and how can you be sure that it's not symptomatic of other economic factors, that it's an indicator rather than a causal factor?
So how do I know that it's not a positive?
No. How do you know that it's causing the crisis, or that it is if not the cause of a crisis, certainly a big part of that, versus something that is indicative of other things going on in the economy?
Well, we've looked at every major country. We took all countries that had over $500 billion in GDP, which is about 85% of world GDP in 22 countries. And we looked at every single financial crisis as defined by Levin. And we looked at 20 factors, private debt increase, government debt, current account surplus, all these other factors. Private debt increases was always present before a crisis, and you never had a crisis where private debt did not lead it. In the other 19 factors we looked at, none of them correlated to crisis in the way private debt did.
On the international scale, we talked a little bit about the government here, and I'm skeptical that you can get people who are elected to office to say to consumers, I want you to have less. I want the number of things you have in your house, or the number of houses you have, or having a house to go away. Just on a political level, I think that's difficult. What about internationally? Have you seen standards, measures taken in other countries that seem to have a positive effect on reducing private debt? Or is anybody trying?
No, it's actually the opposite. Just as it was the case in the United States prior to our crisis, folks were kind of jumping on the bandwagon. Loan growth, and I'm not saying we should have a loan decline. I'm saying we should have a restructuring of debt, kind of a reset button, if you will. And folks will behave, and private debt will increase over time. It's never not been true. But what typically happens is people celebrate rapid loan growth and the things that come from it. When you have rapid loan growth, as has been the case in China recently, as was the case in Japan in the 80s, everything feels good. Everybody wins. Consumers win, spending goes up, tax revenues go up. Everybody thinks it's an economic miracle every time it happens. It's happened repeatedly through history.
As often happens when I talk to people who are familiar with the economy, I'm getting more and more depressed by the minute. Ask if you have good news.
I'll give you a solution that's easy.
A very
You
easy
shouldn't be
solution if you
depressed.
could. I mean, if we were to give you a magic wand, right? So I've tried a sort of a shot at this earlier, and I'm going to go at it again, which is the question of changing the behavior of lenders and what the enticement is for a lender, because we've seen some government programs aimed at getting lenders to give relief. There's a Help for Homeowners program after the 2008 crisis, and what we found is a lot of times businesses don't want to do it, or even if they think it makes economic sense, feel like they're creating a bad precedent, or that they will create legal problems for themselves down the road. What is the enticement for a business, as you said?
You mean a lender?
I'm sorry, a lender. What's the enticement for a lender?
Let me tell you, I was a CEO of a large consumer bank. I was CEO of 2 large consumer banks. And I will tell you, sitting here, that there's always, when you're in that position, there's always problem areas within your institution. And I would suggest to you, if you were a lender and you had a whole bunch of borrowers who had underwater mortgages, it would be an area of concern. And if the government really came and gave a program that really provided me a scot-free way to deal with that problem, I'd grab an heartbeat. And in fact, I would hope for such a thing.
How much have you looked inside the private debt to look at whether there are areas of the country, either regionally or in terms of types of debt, that are really driving this problem?
You know, obviously it was kind of more of a problem on the coasts. It wasn't a problem in Texas because Texas prohibits its second lien mortgages, which was not mentioned earlier when they talked about Texas dodging that bullet. But I don't want to overly emphasize mortgages either. Mortgages happen to be the problem in this crisis. In Japan's crisis in '91, it was commercial mortgages. But we've had crises of this exact same type throughout our history in 1819, 1837, 1856, 1873, 1893, 1907, 1929. Those crises have all related to rapid increases in private debt, but it's been different types of private debt. In 1873, it was railroad debt. There was 25 different railroad companies going into Chicago all at the same time in that period. In 1927, in advance of our crisis, there were 1,000 skyscrapers under construction at the same time in the United States. It was a commercial real estate. So it can come up in different areas. And so to me, the important thing is to watch the aggregates, not to get overly fixated on mortgages. It might pop up in a different form next time.
So it's not just a question of, as you say, commercial versus private.
It can be either, and has been either.
So what's on the horizon for us, for the United States? If you look at the trend lines over time, I mean, do you expect us to continue to increase our private debt and end up where Japan is or where China is?
No, I think, right now in the United States, private debt growth is high, but the growth has been flat over the last few years. It kind of hadn't budged at all over the last 2 or 3 years. And I wouldn't expect it necessarily to grow at a rapid pace going forward. I think we're more in this, what I would call sideways growth mode. When the 50s and 60s, we had growth of 5, 6, 7% per annum in many years. Today, we're kind of in this world where we have 3% GDP growth. We rejoice. We're in a lower growth mode largely because of this private debt situation, and I think that's kind of our new reality, and I think that'll persist for some time. And I think globally, we're in this exact same place. Europe's not growing because of its private debt problem. Japan, the same. China's about to be in this mode. There's no major growth engine in the world at this point in time, and it's hard to see one emerging anytime soon. We could be looking at 10 to 20 years of kind of sideways-ish growth.
Is that because individuals and businesses are largely pleased with where they are in terms of how leveraged they are? I mean, if you look at corporate balance sheets these days, companies are healthier than they've been in memory. They've got tons of cash on hand. They certainly have the ability to pay off or to leverage more if they want. Do you feel like that we've found an equilibrium?
Yeah, I would respectfully disagree with the contention that corporations in as good a shape they've been. The data's in the Fed Z1 report. It's easy to go check. Corporations are pretty close to as leveraged as they've ever been. And I think it's just a situation where when you're like that, you have to spend more of corporate earnings servicing debt and trying to retire debt than you would otherwise spend on investment.
But we also know that they're sitting on cash, so they're not paying them off.
Let me tell you, that's one of the most widely commented on things out there is that we have this glut of savings. It's not in the data. You know, we're not sitting on a glut of savings. We're kind of where we were, 10, 15 years ago on that front. So, I think it's one of those myths that we need to dispel.
You're working on that right now.
I'm trying to.
At the end of this, I'm going to be able to write something for Vox that says private debt explained, so everybody look for that. I guess the last thing I'd sort of want to get at as a category here is looking overseas again, or even to our south, to Latin America. Some of this would seem to be necessary. There's a point, it sounded like you were saying before, a tipping point where you go from private debt accumulation actually being a sign of a growing economy to a point where it becomes problematic. What do you do to encourage private debt in those places where they haven't done it enough?
Well, I would say, having been a lender my whole career, is you don't have to do much to encourage growth in private debt.
Fair enough.
You got a whole industry. It's I keep saying, this is not a moral thing. If you own a restaurant, you try to get more customers. If you own a building company, you try to get more customers. If you're a bank, you try to get more loans. So I think there's this permanent impetus from that industry to grow loans. And the way you control that is through capital requirements. But you do see in developing countries, more of a low, what I would call an LL or low profile. And they do tend to be less stable at that point in time. And it typically has been a very healthy progression when they go from kind of low to medium low, if you will. It's been typically the fastest growing point of that country's existence.
Well, Richard, thank you so much. Really appreciate it.
Thank you very much.
It's always good to see you. Thank you all.